Hey everybody, welcome back to the Heinz and Clark YouTube channel. Today we're going to talk about PTE, or the pass-through entity tax slash credit. Going to go through just some very basic information on it, and it's new to us, but we wanted to get this information out as it's going to be a pretty big player, we think, for a number of our clients and probably a lot of people in 2022.
Yeah, and I think we're going to probably focus on Minnesota for this, since the vast majority of our clients are there or in Minnesota. There's a handful of other states, probably actually close to about half of the states maybe now, that have passed a similar type of election. Wisconsin did year before Minnesota. California did, I know, this recent year. We have a couple clients that we filed for them as well too. But to not try and cover everything, we're going to cover probably just Minnesota here. So if you're in a different state, you have specific questions, let us know.
Yeah.
Why don't we start with the basics? What is a pass-through entity?
A pass-through entity, basically, it's an S corp or a partnership that's it passes through its income from its operations to the individual shareholders or partners. Yeah.
Okay.
That's basically, and those are the entities that are really eligible for this pass-through entity credit, S corps and partnerships. One question we get a lot of times is, well, I have an LLC, but it's taxed as an S corp. So, and that happens a lot. And it's one of the reasons is we advise people setting up a business to file for an LLC, and then we do the S corp election. So LLCs taxed as S corps or partnerships are also eligible for this.
I think we're going to get more. I have an example on that I think we should talk about when we get a little bit further in here. But so this pass-through entity credit, essentially what Minnesota did, they passed the bill, I think it was last August of 2021, allowing these pass-through entities to pay their Minnesota tax through the business, which makes it deductible on the federal income tax return. The way Minnesota structured it is you have to pay it at the highest Minnesota rate, which is 9.85%. So the entity pays that tax to Minnesota, and then the owners get a credit for their portion of it. So if Aaron and I are 50-50 partners in Heinz and Clark, and we paid $10,000 or Heinz and Clark paid $10,000 in this tax, we would each get a credit of $5,000 on our personal tax returns. So it would show on our personal tax returns almost similar to like an estimated payment that we each made. Now, what's the benefit of this? Why did this happen? It really goes back to the Tax Cuts and Jobs Act, when I think that was Trump's tax bill that he passed.
2017?
End of 2017, which limited the deduction on state and local taxes, or SALT taxes, to $10,000. So if if you pay $4,000 or $5,000 in property taxes and you pay $15,000 in Minnesota income taxes, you're not able to deduct all of that. You're only able to deduct about half of it. So this is essentially a workaround for the owners of these pass-through entities to be able to deduct all of their Minnesota taxes, or even actually potentially more than all of their Minnesota taxes, because like I said, this passes through at the highest rate, and you probably don't pay all of that at the highest rate. So
yeah, kind of working back from that, one of the things when the bill first came out, and we were doing a bunch of research on it and trying to identify how this credit was really going to work, is with the entity paying it at the highest level, it's really just an estimate. Outside of where you're paying the tax is calculated and handled much the same, almost the exact same way it was before. You're just paying from the business and getting a credit on your personal return. The income still flows through to the individual return and is still calculated at your individual rates. So assuming you're not already in the max tax bracket, it's technically going to provide an overpayment on the related business income for you.
Mm-hmm.
So it provides this additional benefit that when it flows through when it stays on the federal return at the business level, you're deducting at that 9.85% rate against federal income, which depending on where you are in the federal income tax brackets. It's very beneficial when you're essentially getting a deduction that you won't get, but you still have to pay. It's kind of the way I've been explaining it to people. You're just paying it a different way, and you're actually getting the benefit now.
Yeah, this last year we had a lot of people who are paying it with their S corp return, and they were already going to get a refund on the Minnesota side anyways. So essentially, they're paying this tax only to get a refund of the same amount or more on their personal return. So really, it's really if they can afford to go a couple weeks without that cash, they're going to be able to take that as a benefit, as a deduction on the 2022 tax return. I think that's something we should clarify too. It's you're taking the deduction on the business tax return in the year that you make the payment. So people who are making this payment maybe on March 15th, we got a lot of people sending a lot of money to Minnesota on that day. It's a little bit of a hectic day. And so people who are making that payment on March 15th of 2022 are going to deduct that on their 2022 tax return, even though it's flowing through as a payment to their personal return for 2021.
Yeah, that was an interesting thing to recognize too, is in kind of the weird situation, maybe we don't get into it too much because we're kind of past that point, and really looking into 2022 and how do we have to pay this for 2022 to make sure that we get the benefit for this.
Right. And I think we'll get into the estimated payments on that here in a minute, but
yeah.
Two other things I wanted to just cover. Aaron mentioned the qualifying entities, so essentially being S corps and partnerships. There's also some limitations on the owners. So the owners essentially need to be individuals or trusts.
States or trusts, as long as they're the member.
Yeah. So it essentially can't be an S corp. We ran into this with a client where he was a 25% partner in a company, a partnership, but he owned his 25% share inside of an S corp. And so him owning that 25% share in an S corp made that entire partnership ineligible to make this election. So when he found this out, he immediately went to his attorney to change that so that his ownership is owned by him personally, so that the entire group will be able to make the election for 2022. So, but my example that I ran into on this is a client of ours who he owns it's essentially a company that gets the income through rental. I don't want to get into the specifics of it, but so the income is through an LLC, but he files it on his personal return because it's not subject to self-employment tax. If you want to get more information on that, check out our last two videos. We kind of went in depth on that. But so he makes a fair amount of money on this entity, and it flows through on his personal tax return. So he's not able to take advantage of this PTE credit. And there really hasn't been a reason for him to make the S-Corp election, I think, until now, because he could make a pretty decent payment on the income here, which would be fully tax deductible for him, and he's at probably the highest federal tax rate. So, it'd be a pretty significant savings for him. So it kind of has created another reason for people to kind of make that S corp election for maybe some specific reasons. But
yeah, because so kind of what Steve's talking about, as an LLC that hasn't made an S corp or a partnership election in this, they're considered a disregarded entity that we did talk about last time. The income for them technically flows through to their personal return, but it's on their personal return, and as not being a separate formal entity like a partnership or an S corp would be, they miss out on the benefit, which, yeah, like Steve said, can hurt depending on how much income you have.
Should we talk about estimated payments?
Let's do it.
Okay.
You have to make estimated payments.
Yeah, so similar to if you're making estimated payments on the individual side, Minnesota wants your money throughout the year. They don't want you to just pay it all at the end. So, essentially, I think is it April, June, September, and January?
I think so. Have to confirm. Like the weird thing is, S corp and partnership returns are due on March 15th, a month earlier. But I think their payment for this estimated lines up just like an individual estimated tax payment. So
So I think this is something where, I mean, you certainly would be subject to penalties, potentially interest, if you didn't make these estimated payments. So we would strongly encourage people to look at this and make these payments on the regular scheduled basis. If you need help determining what that amount should be, let us know. The payments need to be made through Minnesota e-Services. So if you have a Minnesota ID number, you more than likely have an e-Services account. If you don't file sales tax, you maybe haven't used it in years. So you might need to call the Minnesota Department of Revenue to get that login information. I will say the Minnesota Department of Revenue is usually pretty responsive. You're not on hold for hours like the IRS. So I know we had people who were doing this on March 15th and were able to get through and get the information. So strongly recommend that you do that and make those estimated payments. And I would actually say too, going back to what I said about the payment's deductible when you make the payment. So I think that last payment you more than likely are going to want to pay in December to get credit for it in that current year on that tax return. So yeah.
yeah, I think that about covers it for estimated payments.
Yeah. But I think that is the key for going forward.
Yeah. The estimated payments as we move through this, we're doing our best to let our current clients know this. But if you see this and you haven't talked to us, or you usually get an extension on your tax return, make sure to mention this to us or your accounting tax firm to get the help that you need. And if you have more questions on this, reach out to us, and we've got a bunch more answers, but we'll go in.
Yeah, there's a
Too much
lot
detail.
more we could go down on with this, but
Yeah.
I mean, I think we've essentially covered what we planned for today, right?
Yeah, I think so.
'Kay.
Seems like it's like one of our most boring videos.
Yeah, but actually, I mean,
Yeah, but
if you-
this
if
is
you-
probably
if
the
you-
best one
if-
for the year.
yeah, if you want to save some money and take essentially a free tax deduction if you're an owner of one of these entities, this is probably the most valuable video. So
Yeah, assuming you're not already an S corp or a partnership, this is like step 2. It feels like.
yeah.
So yeah, well, cool. Thanks for coming.
All right, check out our socials.
Yeah.